Now, on to Evolution. EVN updated their guidance. Weather impact, North Queensland, been absolutely gutload of rain over there. Ernest Henry's been impacted by it up near Cloncurry. March quarter performance. JD, what's happening, mate?
Yeah, that's it. So
the weatherman.
They've come out with a few highlights. I'll touch on the March quarter performance for the company as a whole quickly. 164,000 ounces, 9.6 thousand tonnes of copper produced at an all-in sustaining cost in Aussie dollar terms of $1,290. So as you touched on, their Ernest Henry asset near Cloncurry in Queensland had a fair bit of bad weather about a month ago now. So 29 Metals was another company we saw suffer pretty badly from the downpour they had for about a week over there. And what Evolution did was they ended up bringing forward planned maintenance that they'd had. They flagged that they'd shut down the operations for 6 weeks and then they'd come back to the market. So what they've now done is they've updated guidance, the key numbers there being 660,000 ounces, 48,000 tonnes of copper at an all-in sustaining cost of $1,390. So quite a significant increase in the all-in sustaining cost there. So for Ernest Henry specifically, it means about 17,000 ounces of gold less is produced for FY23. And in terms of copper, about 10,000 tonnes will be 10,000 tonnes less will be produced over the financial year. And they've also mentioned that they will stick to this 6-week time frame and they'll be up and producing again, we'd see probably in about a fortnight or so. So there was a statement, it was only a 2-page announcement that the company came out with, but a statement that really stood out to me, and for people listening to the podcast, I'll just read it out. Group all-in sustaining cost has been impacted by the temporary lower copper production, which equates to an increase of $195 per ounce and is the main contributor to the change guidance. This being partially mitigated by the higher copper price and the forecast lower sustaining capital for the year. So for those that are unfamiliar, we're going to just quickly go through how companies treat byproduct credits. So at an asset like Ernest Henry, the main commodity that they're producing is gold, and they're also selling quite a bit of copper. Now, what that means is a company like Evolution will, rather than add the revenue they receive from the copper, they'll subtract it from the costs of mining the gold. So that
this is for the purpose of reporting your all-in sustaining cost, is that right?
Yeah, that's exactly right, Trav. So we'll pull up for people watching on the YouTube a chart which puts Ernest Henry and all other major gold mines in Australia sort of into perspective. So what you have on the y-axis is all the companies ranked by their all-in sustaining cost and then just a list of the producers. And you'll see Cadia and Ernest Henry at just hugely lower all-in sustaining costs. Now, this is, as I just mentioned there, a direct result of those two assets producing a large amount of byproduct credits, in both these cases, a large amount of copper. So
it's pretty bizarre when you look at that. I mean, you literally see a negative all-in sustaining cost reported.
Yeah,
which unless
you're aware anything,
unless you're aware of the fact that it's a byproduct credit, you just think, how can you produce gold at a negative cost?
Absolutely, and it's a huge gripe that I think a lot of analysts have with the mining space as a whole. It's one of the key reasons Evolution stands out in a lot of comparables and charts that people put together, and it's the key reason why they can bill themselves as a standout, low-cost, high-margin producer because of this gold and because of the copper that they produce. And Ernest Henry produces, amongst their 5 assets, a huge amount of copper, which can be then deducted from the group all-in sustaining cost.
Is there a better way to present this? What is the comparison? If you're going to try and compare a copper gold miner versus a gold miner, for instance, would you have to go down the road of just sheerly looking at profit margins?
I think, Matty, you hit the nail on the head there. Like, we should really just be laser focused on operating free cash flow.
Yeah.
So they're trying to market. They're using it as a marketing tool, essentially.
Yeah, they, in a sense, try and make it easier for analysts, but it's not really an apples to apples comparison when this thing receives 2 revenue streams and the cost outlook is quite different.
Yeah. Now, for everyone's info about what rain does to underground mining operations, when they say impacted by heavy rain, it's not the fact that you can't get there and there's mud everywhere. You think of any underground mine as just a big giant funnel. So between the portal accesses, the ventilation shaft accesses, all the rain just reports to those area and it goes downhill and you will lose access to the bottom of the mine. It just fills up like a bottle of water. So I would anticipate, well, I do know that this is what happened at Ernest Henry. So you end up losing, and then you lose infrastructure, you lose electrical boxes because you literally can't get them out in time as quicker than the water's rising. So that is what heavy impact does to underground mining. So you can see operating in tropical areas like North Queensland, up in like places near Broome and like even in the Pilbara, like heavy rain in wet season has a big impact on compared to operating places like Kalgoorlie. So it's always a risk to identify.